It's May 6, 2010. The stock market is humming along as usual. Traders are glued to their screens, algorithms are firing trades at lightning speed, and investors are watching their portfolios tick up and down. Then suddenly, out of nowhere, the market plunges, and we're not talking about a small dip. In just 5 minutes, the Dow Jones Industrial Average nosedives nearly 1,000 points, wiping out a mind-boggling $1 trillion in market value. Blue-chip stocks like Procter & Gamble, Accenture, and 3M briefly trade for pennies or skyrocket to absurd levels. The entire financial world is in shock. And then, just as suddenly, the market bounces back. This event, now infamous as the flash crash of 2010, remains one of the most terrifying mysteries in stock market history. How could something so catastrophic happen so quickly? Who or what was responsible? For years, theories swirled. Was it a rogue algorithm, a major bank making a fat-fingered trade, a systemic failure in modern finance? The real answer, as it turns out, is even more chilling. Authorities eventually pinned much of the blame on a single trader, a quiet, socially awkward guy sitting in his London bedroom. His name? Navinder Singh Sarao. Let's take a deep dive into this bizarre financial thriller. Buckle up, because this story will give you goosebumps. It started like any other trading day. Investors were already jittery over Greece's worsening debt crisis, but nothing suggested the market was about to collapse in a way never seen before. At 2:32 p.m., the Dow stood at 10,600. Suddenly, a massive wave of selling orders flooded the market. Within seconds, chaos erupted. The Dow plummeted by nearly 1,000 points. More than 20,000 trades were executed at crazy prices. Stocks like Accenture traded for 1 cent. Yes, you read that right. A blue-chip company briefly became worthless. Other stocks like Apple shot up to $100,000 per share. Electronic trading systems started failing. By 2:45 p.m., almost as quickly as it had fallen, the market had recovered most of its losses. But in just 5 minutes, billions of dollars had evaporated. Some never came back. Investors, regulators, and analysts were left scrambling. What the hell had just happened? At first, most fingers pointed at high-frequency trading, HFT, the ultra-fast, algorithm-driven buying and selling of stocks that had come to dominate Wall Street. HFT firms profit by executing trades at speeds impossible for humans, often exploiting tiny price differences across exchanges. But here's the thing. The market had seen wild fluctuations before. This was different. Regulators and financial experts started digging deeper. Was there some kind of rogue algorithm gone haywire? A massive sell order from a panicked institution? A glitch in the market's circuit breakers? Then, in 2015, 5 years after the crash, the world was hit with a shocking revelation. It wasn't a big bank. It wasn't a hedge fund. It wasn't even a Wall Street firm. It was a single trader operating out of a modest home in Hounslow, London. Navinder Singh Sarao wasn't your typical finance villain. He wasn't a billionaire hedge fund manager or a Wall Street executive. He was just a 33-year-old British trader, working alone from his parents' house. Sarao had a reputation for being brilliant but reclusive. Unlike other traders chasing wealth and status, he lived frugally, drove a beat-up car, and seemed to care little for luxury. But he was also a trading genius. His weapon of choice? Spoofing. What is spoofing? Spoofing is an illegal market manipulation tactic where traders place large orders to create a false impression of demand. The trick is, they never intend to execute those orders. Here's how it works. The spoofer places huge sell orders to make it look like the market is flooded with sellers. Other traders panic and start selling, driving prices down. Before the orders can be executed, the spoofer cancels them. Then, they quickly buy at the now lower prices and profit when the market corrects itself. Sarao was a master of this technique. Over years of trading, he had refined a customized spoofing algorithm that allowed him to disrupt the market without getting caught. On May 6, 2010, Sarao allegedly flooded the market with sell orders worth hundreds of millions of dollars, orders he had no intention of fulfilling. This triggered panic selling from other traders and algorithms, creating a domino effect that contributed to the flash crash. The most chilling part? He wasn't even trying to cause a crash. He was just manipulating prices to make a profit. But on that day, in those volatile market conditions, His trades lit the match that ignited a global financial firestorm. For years, Sarao continued his spoofing without getting caught. In total, he reportedly made $70 million through his manipulation tactics. But in April 2015, US authorities arrested him in London. The Department of Justice charged him with fraud and market manipulation, claiming his actions had contributed to the flash crash. Sarao fought extradition to the US, but eventually pleaded guilty in 2016. His lawyers argued that he was not a criminal mastermind, but an obsessive trader with a deep knowledge of market mechanics. They described him as a socially awkward genius who had no real understanding of the global chaos he had helped unleash. In 2020, after years of legal battles, Sarao was spared prison time due to his cooperation with authorities in exposing other market manipulators. Sarao was a key player, but was he solely responsible for a trillion-dollar market meltdown? The truth is murkier. The flash crash was likely caused by a perfect storm of factors. Market structure weaknesses. The increasing reliance on algorithmic trading made markets more fragile. High-frequency traders' role. These firms, instead of stabilizing the market, may have accelerated the sell-off. Spoofing from Sarao. His orders created an illusion of market conditions that sparked a panic. Regulatory failures. The market's own safeguards failed to prevent the meltdown. Sarao might have lit the fuse, but the market's structural flaws were the real dynamite. The flash crash of 2010 was a wake-up call for global markets. It forced regulators to tighten rules around spoofing and high-frequency trading. But could something like it happen again? Absolutely. Markets are more complex than ever, and while regulations have improved, the risk of another sudden meltdown remains very real. As for Sarao, he's now free, but his story remains one of the strangest and most chilling tales in financial history. A lone trader in a small London bedroom, using nothing but a keyboard and an algorithm, nearly brought the entire US stock market to its knees. $1 trillion vanished in minutes, and all because of one man's game. If that doesn't give you goosebumps, I don't know what will.